I always call out to people is like in share markets, you see a lot of investors who are sitting on the fence line thinking, oh, when the rate cuts happen, I'll come and enter into the market, sell it, move out and, get the growth somewhere else, housing prices and the rental prices. I call this a structural issue. Don't wait for this to drop because then you would be fighting and flooding the market. So many other people competing that you would not even have an opportunity. While people think that the new government is all of a sudden going to come in and solve some of these commitments, can solve this overnight. You should sell before the market peaks. I don't see any hope or any light at the end of the tunnel. Co-living properties can generate almost $140,000 in passive income and net of $40,000 in passive income after mortgage repayments, and they sit in an average yield of about 10%. Hello and welcome to another episode of Help Me Buy Property Podcast. In this podcast, we're going to talk about the current market updates again. It's the month of May, and so let's look at what May is doing in the property space. We are going to discuss the prediction secrets for the month, and we would have our own resident data guru, the property expert, Mr. John Lindeman, who would be co-hosting the podcast with me today. We are going to also talk about the interest rate drop, one of the hottest topics in the market right now, where RBA has dropped 0.25% of the cash rate. So we'll talk about what are some of those impacts as well. Let's do a drum roll and bring John in. John, how are you today, sir?
Good morning, Moss, and hello, everyone. It's great to be here again. All very well, and looking forward to this podcast.
Yes. Half a year already. We're literally like around the corner in June. I can't believe how fast the year has gone.
Too fast, if you ask me, but that's the way of it. It just goes very, very quickly, especially when there's a lot happening, and there's a lot happening right now.
Yes. And I'll hand it over to you. Let's kick off. Let's look at what the numbers are telling us for the month of May. And what are we seeing? We've been talking about these rate cuts since January. Or I think since last year, everyone has been fingers crossed waiting for this rate cut and predicting whether it be 0.5 or 0.25 and what does that mean for the future. But let's open up the floor for what to look out for in 2025.
Thank you, Moss. Now, I have to, of course, give you my disclaimer, which first of all, I'll explain what I'm going to cover in the presentation. The National Housing Market Update, the latest CoreLogic data, the effects of the government's housing promises, and of course, that will include the interest rate reductions that are now occurring, state and capital city forecast using our own database, and I'll reveal locations with the strongest growth potential. As you know, we have a general disclaimer that this is general information and you need to obtain your own financial advice specific to your own situation before making any financial investment or decision based on this information. It's your responsibility to make your own individual decisions. So I'm going to cover, first of all, the National Housing Market Update. So what's been happening, Moss, at the end of April, this is the median value, and it shows you the ranking. Sydney is still on top, Brisbane second, Canberra third, then followed Adelaide and Perth very closely together, followed by Melbourne sixth place still.
So sad.
Yes, it is. It's not going to stay like that, though.
I know, right? Yes.
Yeah, and then Hobart and Darwin. But when we look at the growth over the last year, what you can see is, of course, that Brisbane, Adelaide, and Perth have really led the growth. They're the three capital cities that have outperformed the market over the last year. But when we go to the last quarter, you'll notice that Darwin has really taken off, and that I'll talk little bit more about that. What's going on in Darwin?
Yeah.
3.4% in the quarter. Look at the last month, and you can see that growth has continued and translates to annual growth of over 13%. So it's really quite a dramatic increase in Darwin's median house price. But now let's have a look at the effects of the government's housing promises. So the government pretty much won the election by getting the millennial vote, the potential first-home buyer vote, and they made lots of promises. What about supply? What did they do on the supply side? Well, their commitments were $10 billion to build 100,000 new homes for first-home buyers. Sounds good, but with trade shortages, long lead times, it means little over the next 3 years. We're not going to see many of those properties built at all.
Yeah, I think they're already trailing behind like 164,000 homes, right? Compared to 23, 24. It's like while they're promising new builds in the new year, what's funny is that there is already a lag of like 200,000 homes that they have to catch up before they even build these new 100,000 homes, right?
Yeah, it's a massive lag, and I'll show you the slide in a second that dramatically illustrates that. The National Housing Accord was 1.2 million homes. It was 1 million. They've increased that to 1.2. But this is an aspirational target. It's not a commitment. And I'll show you now that graph. This is the past and predicted annual dwelling completions. So you can see the blue columns. That's the number of dwellings, houses and units that have actually been completed each year. And then above that is the yellow line, which is the annual completions required to meet the National Housing Accord target. Now you can see Moss here, they're not anywhere near it. In fact, it's going the wrong way.
Yeah.
But even that target is not enough. If you look at the annual completions required to meet demand from population growth, it's even higher. And we're building about half of the number we need. So nowhere near going to make that target.
Yeah. And this causes not just the demand problems, but also the rental crisis, right? People think that the new government is all of a sudden going to come in and solve some of these, housing crises and the rental crisis. I call this a structural issue, and this has been ongoing for years and years, right? And so, no grants, no commitments can solve this overnight, right? This is going to even get worse. And with the way the population growth is coming through, I don't see any hope or any light at the end of the tunnel, around any of this, right?
No, I think it's getting worse. And the problem is we've got state governments with these utopian aspirations about the quality of rental accommodation and so on. But when you've got these massive shortages of accommodation that are coming on over the next few years, we're going to see people accepting substandard accommodation, living in garages and rooms out the back, and people sharing houses, many families together, young people staying at home longer or living in group accommodation. So
and that's why when we talk about co-living properties, I've seen a lot of people are talking about housing with multiple occupants or shared housing and communal living, etc. All of that, co-life opportunities. I think one of the biggest things that I consistently see is you look at a 3-bedroom, 2-bathroom townhouse, house, or an apartment, the rent doesn't change at all, right? And they keep rising at the same pace. I was talking to a client and they are looking for a rental for a 2-bedroom, 1-bathroom. And this is not even inner Sydney. And the rents in Mascot right now sits at almost like $1,300 to $1,400 for a 2-bedroom apartment. Like, that's just ridiculous, So I remember 2016 when I was there, 15, 16, I was there, these apartments used to rent at $500, $550. And so the prices of these apartments are relatively still very similar. So they haven't seen massive growth in apartment prices, but the rents have just gone through the roof. And so the question that always comes down to, and this is an interesting question that I'm going to throw at you, John, as well, is that, considering that the rental pressures are building up on the units as well, do you think, this market would ever turn and you would see that apartments basically become the shiny new thing for investors to start chasing?
I certainly think so. And we have seen direct evidence of that. And we just went over to Adelaide and had a look at the unit market over there, and you can see this dramatic change that's occurring. Adelaide's got one of the highest median house prices in Australia, next to it's just below Brisbane and Canberra. And so people can't afford to buy houses, and they're starting to look at units as an alternative form of accommodation, both for rental and owner-occupied. And that's not really been the case in Adelaide before. So things are changing quite dramatically. So, yeah, let's have a look then at what they made, the commitments on demand. Well, they're going to maintain negative gearing, capital gains tax, no change there. They've said they'll put pressure on APRA to reduce the 3% assessment buffer. So, as you know, when you apply for a home loan, you are assessed as if the interest rate was 3% higher than what it actually is, to make sure you can afford repayments if interest rates go up. But they're actually going down. And so there's no need for that buffer. And the government said, we're going to put pressure on APRA to reduce this buffer. Now, if you reduce the buffer by 1%, that's an effective 1% drop in interest rates. So it's going to have a massive effect. And no one's really talking about that.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages, or off-the-plan properties or apartments. Get yourself copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book. And how, because APRA is almost a regulatory body, right? How much can the government influence a regulator? That's the question, right?
Well, that's right. They sort of have to do it through the back door and say, look, if you guys reduce the assessment buffer, there might be a nice ambassadorship or something, so they'll try and other ways of motivating them. But they haven't got any direct leverage. But then we've also got the 5% deposit guarantee to all first-time buyers.
No caps. Yeah, it's a big one. I think huge. Yeah. And I think even lifting some of these first-time buyers caps are being lifted as well, right? For people who are coming into the market, even not using the first 5% deposit schemes.
Yeah. So all of these are going to have a massive impact on increasing demand. And then, of course, we've got the variable interest rate trend. So you can see there that the interest rate cut in May, but the ANZ Bank, and this is the ANZ forecast, is predicting further rate cuts, and you can see what's happening to interest rates and what's likely to happen over the rest of this year. Several more cuts.
Yeah,
all of that means that there's not enough new home builds. We're going to see a massive rise in the number of first-home buyers. 3 or more interest rate cuts this year will also encourage investors to come in as well. So we're going to see more investors and price rises in the most affordable locations of our major cities.
Yeah. One of the things that I always call out to people is, like, in share markets, you should sell before the market peaks and you should buy before the market hits the rock bottom, right? These are the words of Warren Buffett, not my words. And so I tend to always be influenced by some of that mentality and mindset as well, right? And you see a lot of investors who are sitting on the fence line thinking, when the rate cuts happen, I'll come and enter into the market. Or on the flip side, I'll get the maximum price out of Perth and then sell and, move out, right? I'm always of that opinion that if you're asking for 600 for a sell price, and if you get like 580, 570, sell it, move out, and, get the growth somewhere else or make your ROI somewhere else, right? Same with the interest rates. Don't wait for this to drop, because then you would be fighting and flooding the market with so many other people competing that you would not even have an opportunity, because while your servicing comes back, the price point disappears, right? So it's a catch-22, right? So it's a very interesting dilemma. And yeah, I'm sure that, the investors do what the investors do always. But, it's just a piece of advice.
It is very good advice. And the thing about investors is they tend to follow the money. So at the moment, the share market's not doing much, and the property market is moving ahead in leaps and bounds. And so they will move from one asset type to another. So I think we're going to see a lot more people moving into property investing and not investing in shares or crypto so much as they have been. So I think it all looks like price rises occurring pretty much everywhere around Australia, but especially in the most affordable locations. And when we look at the first-time buyers, where the incentives are being made, interest rate cuts, nearly half of the market is going to benefit from the incentives and the interest rate cuts that are being put forward. So now let's have a look from my database. We look at our database, say all the suburbs in a city, and then look at what's occurring right now. And this is a hypothetical city, thank goodness, Moss, not a real one, because you could see, nearly half the suburbs experiencing heavy falls, that is falls of over 10%. But if it was improving a year from now, it might look like that. And the way you can tell is you look at the size of the wedges, the colours and the size, and suddenly the red wedge is bigger, the black one is smaller. And then 3 years from now, it might look like that, where half the suburbs are predicted to experience strong growth. So when we look at the real cities, we can use the same method. We factored in now into our database is the dynamics of both the first home buyer incentives and the interest rate reduction. So we're looking ahead, not just what's occurring in the next few months, but over the next few years. And you can see the Sydney outlook is looking a lot brighter than it was a few months ago, with over half of the Sydney suburbs in growth and about a quarter in strong growth. And that's going to increase even further over the next 3 years. So the question is, well, where are those suburbs located? And it's going to be first home buyers and investors that are going to buy. And this is where the growth will be concentrated, according to our database, in the outer western suburbs of Sydney, around Blacktown, also around Liverpool and Campbelltown. These are the markets which are likely to experience the highest price growth over the next few years. And when we aggregate what they're doing right now, the median price is around 800,000. They've already gone up 13.2% in the last year. So Sydney is actually growing quite strongly, but it's all at the most affordable
price points.
Yeah, exactly. So let's have a look at Melbourne, and you can see no red at all. There's no suburbs with strong growth. But when we look at the prediction, it's saying that over half of Melbourne suburbs will be experiencing moderate, some will be having strong growth, and that's going to increase as well over the next 3 years. No black at all. And where will they be? Again, they'll be first-home buyers and investors. Investors haven't really moved into the Melbourne market because the rental yields aren't strong enough, but they're going to increase dramatically. As we said, a massive rental shortage. Melbourne's receiving something like 140,000 increased population each year. That's what it got last year. Massive numbers, and these people...
Big numbers.
Yeah.
They are as big as like Queensland, right? When you look at population growth, Adelaide and Queensland has always been top of the charts, with Perth, catching up. And every time the population growth happens, provided the infrastructure is there, the growth follows, right? And that's the trend that we always tend to see.
Yep. So when we look at Melbourne, where to buy for growth in Melbourne? Well, it's the outer suburban areas, those first-home buyer suburbs around Melton, Craigieburn, and of course Cranbourne and those areas, but also the Bayside suburbs, the cheaper Bayside suburbs like around Carrum and so on. Those areas are also experiencing strong growth, and even out as far as Geelong, some suburbs are now starting to experience strong growth, and that's likely to intensify over the next few years. Melbourne is a lot cheaper. When you look at those first-home buyer suburbs, they're under 600,000. And the growth over the last 12 months has been around 8 to 9%. So massive. And that you can see the graph there of what's been going on. Price rises occurring, and they will intensify. When we look at Brisbane, well, it's a bit different there because we've already had 3 years of strong price growth, and that growth is now sort of moved into the upper areas of the market, the upgraders, the final family homes. So the growth is sort of, remaining quite constant, but it's not, the red wedge is not increasing in size, no more so.
Not affordable anymore.
No, it isn't. And so it's all the growth is now concentrated in those areas where people don't have large mortgages, have pretty much paid off their mortgages, and older people looking to downsize and retire. So it's the best performing capital city right now. But what's going to happen over the next few years is that people will start to move to regional markets and retirement. Hervey Bay, for example, a lot of growth potential there. There's been no growth there for 3 years. Very affordable. The Hervey Bay location, 681,000, and prices have only gone up 4.9%. So you can see a lot of people, older people, moving to locations like that and generating a lot of growth. Perth, again, very strong property market performance over the last 3 years, and that's starting to moderate. It's not going to crash or anything like that. All that's happening is the growth is slowing down simply because it's becoming too dear for investors. All the first-time buyers have got into the market and already bought properties. So, it's just slowing down, and it'll probably pick up again because of all the incentives that the government's introduced, and first-time buyer incentives, and also the interest rate reductions. So the growth will be moderate growth, but it will continue over the foreseeable future. And also the same downsizer effect, so that people will move to regional markets, more of them to Geraldton and Busselton, those sorts of areas.
It's quite funny. I posted a video last week. I think it was last week, where I said, people who have been buying in Perth over the last 3 years, it's time for them to sell and move out, right? And I did say out in the video that this is not a panic video. Like, I'm not trying to say that the market is going to take a nosedive. That's not what the intention is, right? But I know that, there are areas where people, especially investors, were being very emotional. And so the market really peaked, like, areas like Gosnell or Mandurah or, Maddington or, pockets as well, right? Where, 3-bedroom, 1-bathroom went all the way up to like 740, 750, right? And so for an investor, or even like first-time foundation investors, first-time investors, for them, growth is important. If they want to cash out then and use this money for something else, be it a flipper, upper fixer, flipper, or, bring this money back and split it into 2 deposits and do this again, it's a much better opportunity to take an exit at the peak, right? Rather than waiting for the market to, moderate and, that emotional purchase are disappearing because owner-occupied does not, bid that high, right? And so that was the context around this. People naturally think that, Perth is going to take a nosedive, but I think Perth in 2025 is very different to the Perth in 2015. It's going to moderate where people were being silly. Yes, the market is going to readjust and it's going to come in at a much moderate level. But I totally agree that, we're not see any nosedives happening in Perth.
No, I think the situation is completely different. There's still a massive shortage of housing in Perth, and the rental vacancy rates are very low. We look at the rental vacancies, they're not going up. So there's absolutely no reason for people to panic. That's the 865 figure you see there is the lower price point, the bottom quartile. It is a lot higher than it was, and it's gone up over 22% in the last year. You can see in that graph that the growth has pretty much deserted those cheaper areas, but they're not going to crash. It's just simply a time to say, reconsider and say, well, should I sell, buy elsewhere as an investor? Because it's going to be moderate growth, if anything, over the next few years. Darwin is the really interesting one. And this caused a shock when I looked at the prediction for Darwin. Right now, about well over half of the suburbs are in moderate growth and some are booming. But the database said, but over a year from now, more than half of Darwin's suburbs will be booming. There'll be really strong growth. And then it'll pull right back again. So what's going on in Darwin? This is quite amazing. So I had a look at the statistics. It's all investors. And here's this really interesting This is the number of housing finance commitments made by investors in ACT, Tas and Northern Territory. And it's a really good indicator as to the volatility of markets and their boom potential. If you look at the ACT, you can see there that the number of investor loans has really nosedived, and it means there's absolutely no boom potential because owner-occupiers don't generate booms, they generate growth, but not those booms. And the same in Tassie, there's no potential there for a boom. But have a look at the Northern Territory. The number of investor loans has increased dramatically since about September last year. And that's a real worry because these investors can go in, they can go out just as easily. They don't live in the properties. And so this has really got double potential. I'd be very, very cautious about anyone buying investment properties in Darwin right now. What do you think, Moss?
100%. I completely agree. I think we have seen these pocket and like this problem is twofold, right? One is there's buyer's agents that is basically under every rock right now at this stage, and they buy properties by just doing the desktop research, and they don't understand what the data that sits behind this tells you. And so if you're just chasing the yields and you're looking at the filters of where the growth is going to project, of course the numbers look great, right? And anyone who's looking at the data would, eyes closed say that, oh, there is growth coming through, and you would basically go in there and invest. But we know for a fact that, because these are investor-led, opportunities, as soon as the rental disappears, something happens to that volatile market, the rental market, all of these investors would basically feel the heat, right? The interesting bit is this, right? And this is like Perth 2.0 again. Because what is happening is that while the yields are high, the rates might come off and the investors would stick around for a lot longer, right? Maybe 3 years, 2 years, 3 years, and the market would keep seeing the boom. And so opportunity to make short-term in where you go in, make the money, get out is definitely there. But if you get in the wrong timing and if you can't time this properly, like there would be massive losses, right? I know people who have bought in Perth in 2014 for I think $600,000 or $700,000, took a nosedive for the market and only sold in 2025 to break even, right? And so this is what is going to happen to NT over a period of 6 to 7 years, where there'll be a lot of people who would buy it at the peak thinking that the market is going to see more growth. They'll see interest rates coming down, and so they'll be really happy that, hey, my property is positively geared. And then, the market does what the market does with volatile, workforce disappearing. And these people quite suffering in the medium to long term as well. So completely agree with you.
Yeah, and it's interesting that in Darwin, Palmerston, around 50% of all the properties are rented. So there's huge potential for volatility, and 15% of the population in the Northern Territory moves in or out to other states and territories every year. So that, that's much greater than any other city or state. So huge potential there for disaster. And the best thing is just to simply stay away if you're not sure.
Yeah.
This is a real warning.
Yeah.
Now, Adelaide is the one of the strongest performers right now. It's looking pretty good with a third of the suburbs booming. It's going to come back a year from now to about a quarter booming, but still well over half in growth. So again, if you've got investment properties in Adelaide, there's really no cause for panic. There is a small wedge of black there a year from now, and that's likely to increase a little bit. So you need to be a little bit wary about where you've got investments in Adelaide, but overall still half of them in growth. Now, the interesting thing, as I mentioned before about the Adelaide property market, is unit markets tend to follow house markets. We saw that in Perth where the house market boomed. All the cheapies suddenly weren't cheapies anymore, but the unit prices didn't go up. And so it meant they were far more affordable, and first-time buyers, a lot of them turned to units, as did investors. Let's have a look at the cheapest houses you can buy in Adelaide right now, around $681,000. But what's happened is the prices have doubled over the last 4 or 5 years. You can see that red line doubling in price. What about units? Well, at $512,000, that's in Adelaide CBD. And look at that, the price hasn't changed at all.
Yeah.
So, this means either Adelaide CBD units are going to boom or the Adelaide house market is going to crash, and it's not going to crash. This is the way I can see the future performing for Adelaide CBD units. We checked our database, And first of all, we looked at how many there are. There's over 100 units available. I'll show you that again. So there's about 104 units in the Adelaide CBD on the market. Look at the database predictions as saying Adelaide CBD, the market suits buyers. However, the short-term price growth movement trend, you can see there's strong growth. That means over 10%. The short-term cash flow potential is also strong. The current rental yield is 6.2%, and that's likely to go up to 7.4% with strong growth continuing for some years. So if you've got a spare $500,000 to invest, Adelaide units, the CBD that is definitely got a lot of potential.
It's a very interesting dynamics. I think we have seen that happening to Brisbane as well, right? Melbourne is the only place where units haven't really grown in value, and that's predominantly because there is so much oversupply of units, and the amount of land that is still available to Melburnians is massive. And so naturally people default to houses with lands versus units because the price point is very comparable. So Sydney unit market, especially like in Fortitude Valley or all of these areas which are closer to coastal, they've seen some massive growth. And Adelaide people have a massive love to city and around, like the east and the west is where everyone wants to basically stay. So naturally, if they can't buy properties in Glenelg or Brighton, but they can come in and buy an apartment in the city, then of course that preference would always be there.
Yeah, and it's because buying in unit markets is different to buying property. You've got to watch out for body corporate issues and
stratas, and
it's more complicated. But nevertheless, the market itself is poised for good growth.
Thank you very much, John.
That's all right.
And for viewers and listeners, if you have any questions, comments, or concerns in relation to the topics that we were discussing today, please reach out in the comments. If you want us to, review any particular areas, any LGAs, any suburbs, reach out to us at info@helpmebuy.com.au or drop it into the comments. Talk about some of the suburbs. Join our Facebook group called Property Investment Australia. Thank you for listening to us today. Take care, stay safe, be kind, keep investing. This is John and Moss checking out. Adios.
Bye, everyone.
Thank you.